Hi, hi, Rob Lukey. I wanted to share a couple of charts with our clients. This is it's 5:30 a.m., about an hour before the stock market opens. This is a inflation chart. I would just want to kind of give everybody some perspective because I was thinking about it. I thought I would share it, and I was looking at the inflation rate. As we can see, I mentioned that I thought inflation probably has peaked, right? And in looking at it, it probably has 7% last year. It's already down to 6.23. Here's in 19 this is 1974 where we saw the inflation and interest rates get pretty out of hand with the gas shortage occurring. This was when you remember, if you remember, there was lines that you couldn't get gas and so forth. These are some of the peaks that occurred earlier in our history, right? The recession, and then every time we had a war, we would have some deflation occur. That's in it. So it's pretty typical that during times of high peaking inflation, this was in the 1990s, right? Here is in the 2000s, right? This is in the recession, the dot-com area, and then you had the housing market, right, where we saw this kind of peak of inflation up to 4% right before the housing market. I'll show you what that looked like in relationship to the federal funds. So what does all this mean? Well, I mean, everybody kind of assumed we were going to get this big inflation spike with all the money that was dumped into the economy. So and we had federal funds rates, right? If we look at this, not that chart, this chart, we had federal funds rates all the way down right into basically zero. So, and look at this is a chart with the S&P 500 in relationship to the federal funds rate, right? Federal funds rate versus the S&P 500. So the red bar is the federal funds rate, and the chart that this is the S&P 500. And if you go back and we look at kind of what occurred, this in here is the dot-com area. This is from 1990. Let's say the market really started to take a run in 1992 here. This is coming off of the Gulf War, and this is where we started to see the market come back out of the 1992 with the dot-com area, and the market started to run up, and we had this big move in the S&P 500 and in home prices, and then we had the dot-com bust. But if you look at the federal funds rate, they were set up during this market move. Look at where the federal funds rate was. It's all the way up to 5.8%. Matter of fact, I remember getting a 6% interest on here on a 30-year fixed on a primary residence. That was one of my first homes I ever bought. And so you look at this in relationship to this, and you say, well, what happened here is that there's kind of a mixed message. Number one, when the Fed's raising interest rates, they know that the economy is doing, or at least they feel comfortable that the economy is doing well enough that we can raise interest rates. That's number one. So the question becomes is that, like this move in the 1992, as this federal funds rate increases, and this stayed, remember, for years up at this level, is the economy strong enough to handle these moves and inflation start to come off? So let's look at this chart from 1995 and go back to this chart and look at what was happening to inflation during this time. So inflation, the federal funds, typically we shoot for a 2% inflation. So we were sticking at 3%, had spikes in inflation up to 3.32%, all the way up until 2000, where we had this move and where Greenspan came out with the idea that we had this exuberance in the market, and that he actually made a statement regarding similar to what you saw Powell make yesterday in regards to the employment rate, and stating that that was a huge issue in regards to employment. And then right after that statement from Greenspan, you had this dot-com occur, obviously, where you had layoffs and the employment rate got much, much higher than it was in 2000. So here we had the we had in obviously the September 11th, and we had this drop, the dot-com era, right, where we had this dot bomb. And here we had the federal funds rate drop off to 1.75, and then we had this another move up in federal funds rate, right, as we were recovering out of this recession from the dot bomb era, right? So here we are, the S&P 500 is still moving up, and not only that, but we had this huge move in home prices during this time. From 2000 to 2007, we had this huge increase in home prices, even with the federal funds rates moving up, interest rates going up, and we had that little problem with CDOs that occurred, right? Where we had this big issue in CDOs and the market dropped, and then we've stuck at this federal funds rate for quite some time, all the way up to moving it up into right before we had the occurrence of COVID and so forth, where we had the economy shut down and so forth. So we haven't seen this spike in inflation for quite some time, but the federal funds rate, set at really at 2 point, even if it gets to 4. And so, I mean, historically, that federal funds rate isn't really that high in comparison, even if you look at what Powell said yesterday regarding to getting back to 4.5, 4.75 federal funds rate. So my whole point that I'm trying to just was looking at it, I still think inflation peaked. I think that it'll be what happens going forward is really going to be a function of how strong the economy is. I mean, if we see the economy strength that we had rolling into the 2000s, you could still see a stronger real estate market as people get used to this kind of the Fed raising the federal funds rate is such a newsworthy item right now, where in the past I don't think it was as significant to people as it was unless you were trading the markets, right? So anyhow, these are the little shadows here are recessions, right? That we had heard, that I already pointed out. So what happens over the next period of time will really be dependent on how strong the economy is. If the Fed does the right thing, which is raising, I think is the right thing to do to bring inflation down. It was ridiculously stupid. And I think they waited too long to raise. So raising interest rates, staying here and letting the market adapt to it, I think that over the next, I still believe kind of in my thought process, unless the Fed raises to levels that are just insane, but that's not what they said yesterday. I think you could have a fairly soft landing. The market gets back down, and obviously they're saying over the next 2 to 3 years, we get back down to the 2% inflation range. What does that mean for home prices, stock market? It means for more of kind of a typical return, 8%, 5%, the typical returns that we see on average over a period of time, instead of these huge spikes that we see during a time of the Fed trying to get a recovery going. Anyhow, that's all I have. I just wanted to share those charts. I thought they were pretty interesting in relationship to the Fed funds rate, in relationship to the S&P 500, and obviously home prices. Thanks.